Hey, flip paper, not houses. One wrong clause and you're in court, so let's fix that. In this video, you're going to learn how to wholesale real estate in 2025 without violating broker laws, and also how to route your assignment fees through the right entity to slash taxes, and the privacy tricks that we're using to keep the angry sellers, real estate agents, and buyers from targeting you. Okay? Let's get started. Okay, so when I mean flipping paper, what am I referring to? I'm referring to wholesaling real estate. And if you're not familiar with that term, a quick refresher here. When you're wholesaling real estate, what you're doing is you're tying up a property under contract. And then you're going to turn around and you're going to flip that contract to another investor. When I got started investing in Winston-Salem, North Carolina, that's how I got my feet wet in that particular market, was by working with a local wholesaler who was flipping me paper, and I was turning around and closing on these properties. Now, there's two routes you can go with wholesaling, all right? You can do the standard assignment, which means, just as I described, you enter into an agreement with the seller. You tie the property up under contract where you're agreeing to buy this property at a set price. And then you turn you around and you go out there and you market it to an investor like myself. Hey, I've got this great deal. If you turn around and you pay me a fee, then you can step into my shoes with that agreement. Now, if you're using that type of strategy with your wholesaling, a couple of things you need to be aware of. Number one, make sure you're always writing your agreements in the name of an entity, and we'll get into this, and state, in addition to that, say, Blue Falcon LLC and or designated entity. That's how you should need to make your offer, because that gives you the flexibility to assign that contract to an investor. So they can't tie your hands and say, hey, you can't be transferring this property. We have a no assignment clause in there. It's not available. So make sure that you have that type of language in there. Now, another way in which you can put a wholesale together, which is important to know this because in some states, and I'm going to show you here those states that you need to watch out for if you want to engage in this type of activity, you need to look at using a double close. Now, a double close is a scenario where you are going to actually buy the property. So let me just show you what I'm referring to here. So here's the seller of the property right here. They own the house. You're the middleman right here, and what you do is you enter into a contract to buy this house. And then you find your investor over here who's going to buy the property from you. So you end up actually coming to the table in escrow and you close on the property in your name or in the name of the entity is how you should be doing it. And to do that, you're going to have money from a third party. A lot of times people will use fast cash lenders, they're going to charge a few points to put this deal together. There's really no interest to be made because you're closing at the same table, meaning you're buying the property and immediately you're turning around, you're selling it to this individual here. So your lender loans you the money, you pay it to this person steps in, gives you money, and then you pay it back to your lender. So the lender's just cycling the funds through you. That's one way these take place. Now, there are certain escrow companies that allow you to do this double close strategy with the end buyer's funds, meaning the end buyer will give you the money to buy the property. They have a secured interest in it. They turn around, you transfer the real estate, and then you wipe it out. On the back end, they take the money or the property in exchange for the money. That works as well, but there's very few people that allow you to do that. And the other problem with this double close is that if you're not selling to an investor and you're selling to an FHA or VA buyer, well, you're not going to be able to get that done because many times they want to see seasoning. They have seasoning issues there where the property cannot transfer within 6 months from the original seller to the end buyer in order to obtain the loan. So you really need to know who your ultimate buyer is going to be. A lot of times on our deals, we just work with investors. We no longer work with homeowners on our flip property because we just found it was easier and we had more flexibility. But you'll know that because you're going to figure out who you eventually want to flip the property to. Now, the reason I bring this up is because there are some states out there that have targeted wholesalers in the past couple of years. Now, if you look on the screen right now, I've listed out those states that I'm aware of that target wholesalers with these types of transactions. And you need to be careful if you're operating in those states because many times it requires that you either be licensed or you're limited to how many deals you can do, or you have to do a double close, that they don't actually allow you just to flip the paper to an investor. You got to close on it in your own name, and then you can turn around and sell it to the homeowner or to the investor. And so it's really important you're aware these are the problem states that are up here when you're engaging in wholesaling of real estate. And so this crackdown has started, and you see other states out there as well that are exploring potentially passing laws. It's really driven by real estate agents, okay? Because they think that you're, cutting into their business is essentially what it is. I recently dealt with a client that was working on a wholesale in California, and unfortunately, the broker representing a seller found out about this because they saw the marketing of the property, and then they threatened to sue my client for fraud, misrepresentation, and to report them to the Realtors Association. They were just trying to make the life very uncomfortable. Now, there's not a lot of teeth behind that, but just think, if you're a wholesaler, you don't have time for this. You got to move on. So it's really important that when you're structuring your wholesale deals, you're doing it in a way that doesn't alert either the broker or the real estate agent or the seller that you're a wholesaler and you intend to actually flip that deal to someone else. Because if they think that there's still more meat on that bone, they're missing out on that. They're definitely going to pounce upon you. So you have to be careful on how you structure this. So let me just show you. If you're going to wholesale property, what I've been working on with clients for the past 18 years when it comes to wholesaling is we like to use entities. Now, number one, you have a tax issue here. When you're wholesaling real estate, if you're doing it in your own name, you've got liability exposure and tax issues, meaning that every dollar you make is going to be considered active income. So if I sell or wholesale 3 properties and I bring in $24,000 from those wholesales, all of this is considered self-employment income, which means it's subject to, of course, income taxes and self-employment taxes, which is an additional 15.4%. Now, for wholesalers, you've already got pretty thin margins, not on all the deals. I mean, I've seen some pretty fat deals out there before, especially on commercial deals. But the fact of the matter is that I don't want to have to pay any more in taxes than I'm required to do. So for a wholesaler, what we should be looking at setting up from a tax standpoint is you want to set up either an LLC or a traditional corporation. Many times I'll just go with the LLC. I'll set up an LLC, and I'll treat this LLC as an S corporation for federal tax purposes. So for wholesalers, generally we'll start with an S corp. And this is where you're going to receive all of your income from your wholesale deals. All the income will flow into here. Now, you've got your S corporation set up, you will become an employee of this S corporation. So you're a manager, or if you set up the LLC the way I like to set it up, I list you as a president. All right, I don't want people necessarily to know that I have complete control over this. I want them to think I'm an officer of a larger company. So I'll put you down here as a president, and then we'll give the president a salary. And so maybe your salary is $1,500 a month. I know it's not huge, but the numbers work out in your favor when you keep your salary small, because your salary is subject to self-employment taxes. So if I'm paying myself $1,500 a month, that equates to $18,000 a year that's subject to 15.4% employment taxes. Now, if I wholesaled this year and I made a total of $88,000 from wholesaling, right? $18,000 is going to go to me in salary. That's going to leave $70,000 left for me to take what's called a distribution. Now, this distribution that I take out of my LLC, that is not subject to this 15.4%. And so just do the math here on that $70,000, you're saving about $11,000 in taxes by that one simple strategy. That's why I'm telling you, if you're wholesaling real estate, you want to seriously look at using the LLC, treat it as an S corporation. But more importantly, another aspect of this you may not be thinking about is liability. You see, when you flip that contract to an investor and that person comes in and they buy the right to close on this property up here, if that deal goes bad for this investor, maybe they get into the property and they didn't do their proper due diligence with their inspection and they find serious problems with it and they felt they overpaid, they're mad as a hornet and they're going to start suing people, and they may sue you. We've had some wholesaling clients that have been sued by the actual investor who closed on the property because they found something wrong with the property after the fact, and now it's just a shakedown. So by having an LLC there, you're insulating yourself individually and you're forcing them to sue the company and not you personally. So that's why we use the LLC. But here's the thing I want you to understand about this strategy that I feel is really important and is a mistake that I see all the time when I'm talking to these wholesalers that I run into at different conferences. A lot of them come through different groups like Pace Morby, who's out there, big wholesaler, teaches people how to wholesale. And the clients that go through his training many times will get funneled into this company it's an internet mill, and they set up entities and they say, hey, just set up an LLC for your entity, for your wholesaling. What they don't realize is that if you just set up this one structure, you're missing out or you're creating a potential problem for yourself down the future, meaning that when you're putting your agreements together, you always run the risk that that seller or their agent is going to know you're wholesaling this deal. So what I prefer to do is not make the contract in the name of my wholesaling entity. Instead, what I will do is I'll either create one of two things. I will create a child LLC. This will be a Wyoming child limited liability company. And so this LLC that I set up in Wyoming, I love to do these Wyoming LLCs this way. I set up a Wyoming LLC, and this is what enters into the agreement with the seller to hold the property. And the Wyoming LLC is then owned by my S Corp LLC. So it owns the LLC. Now, if you go this route, okay, know this. Do not pull an EIN for the LLC. Just set it up. I wouldn't even draft an operating agreement. Just set it up, and you're going to see why here in a moment. Don't pull an EIN. Just record it, get the name, and then enter into the agreement to tie up this property. Now, why am I doing the LLC strategy? Because when I find my investor that's going to step into my shoes, I'm no longer selling them the paper to close on the contract. See, the contract runs from the seller, right, to this Wyoming LLC. The Wyoming LLC has the right to close on that property. It's the one that's tied up the deal. So in order for my investor to take over this deal, all they need to do is take over my LLC. So I just transfer them the LLC. They can then go and obtain an EIN number for themselves for that LLC. So you're never associated with it. It's Wyoming. It's privacy. Your name's not listed as a member or manager. So no one knows if it was this entity or it's the investor. It's all completely private. So it gives us a lot of flexibility in our deals. And even with that language I told you earlier, and or designated entity, you don't even need to do it here because it's all going to close in the name of that Wyoming company. And I'll tell you this, from an investor standpoint, to get a deal that already has an LLC ready to go, that's a bonus for me, okay, as an investor coming in. So I like that Wyoming LLC strategy, not to mention there's an additional layer of asset protection for you now. Because this gentleman here is buying the LLC. They're not buying the contract. So that problem I talked about earlier, you're minimizing that issue now because they're just buying the company and they take whatever the company has. All right, and the company has a contract, so their claims is only going to be here if they find out there's something wrong with the property that wasn't disclosed by the seller and not over here. So that's one strategy on how you can structure these deals. The second way in which you can do this, if you don't want to create LLCs, and I get it, some people are adverse to that, but I think it's the simplest approach. Another thing that we came up with here at Anderson to help our wholesaling clients is we created what is referred to as a wholesale trust. We'll call it WST is a bad acronym because that also means Wyoming Statutory Trust, but it's a wholesale trust. And a wholesale trust is similar to a land trust, but it's not the same. I mean, this type of trust is custom drafted specifically to take and enter into an agreement on a piece of property, and it's set up so that it can be then flipped to an investor. So like the LLC, you're doing the same thing. But unlike an LLC, it doesn't have to be recorded anywhere. It's a private document. So you can just crank these things out as you're putting contracts out there. You create a new trust, create a new trust, create a new trust, and just take them all under the name of the trust. I've been using this strategy for years once I came up with it, and I've got a lot of clients that love using the wholesale trust to put their deals together under. And as long as you're just working with an investor, you shouldn't have a problem with it. Sometimes, though, I do feel that when you use a wholesale trust, there's a few more components there that you have to possibly explain to someone as to how it works. But both of those work essentially the same way. Now, the only drawback to the wholesale trust is that it doesn't offer you any asset protection for your main company because you're initially the beneficiary of this trust and you're selling the beneficial interest to the investor. Trusts do not provide asset protection like LLCs. So I would prefer to use an LLC strategy when I'm doing this. Now, compliance-wise, if you're going to start wholesaling here in 2025, it's really important that you understand your state laws. I've given you those states that there's a problem with. But more importantly, you have to make sure this. Some states like Texas, for instance, your contract is always freely assignable. So you don't have to worry about some of the putting in the right language in there as I described, that because any contract in Texas can be assigned. Avoid marketing the property address publicly unless you've closed or you disclose that you have an interest. So a lot of states now require you to disclose that you're doing this. And so know whether or not that is, because as you saw on that sheet that I put up there, and by the way, you'll be able to download it in the show notes. I'll have that available as well for you. There'll be a link in here. On that sheet, if you're doing that in one of those states, there can be some substantial penalties if you're not disclosing. The other thing that I would tell you to do is make sure you're pulling the money out of your company as quickly as possible. So do not allow assets to continue to accumulate, income to accumulate for very long inside of this entity, because, maybe there's a wild attorney general out there that, there's not a statute yet, but they feel that it violates the spirit of the law and they want to come after you. They're going to come after your LLC. So what you should be doing is making sure that you're pulling your money out regularly so you don't leave a lot of assets inside of there. Or what you might want to consider doing is maybe, and I've done this for a lot of clients, set up a separate Wyoming LLC just to market the properties, right? So you've closed on it. You've got an LLC that's in privity of contract with the seller, but you're not the one marketing it, or you've got another entity that's doing the marketing. So that's good from the standpoint that if somebody sees it, they're not going to associate all this back to you. So I have clients that utilize that strategy as well, and they're just trying to fly under the radar and not create additional problems for themselves with potential people looking at it and thinking, oh, well, I could have made more money on that deal, so let's try to unwind it. If they ever came to you and they say, hey, are you trying to market this property? No, I'm not. I'm not trying to market this property. I know some of the people that are viewing this are going to think, well, you're just lying. No, I'm not lying. Understand that when I say I'm not marketing the property, I'm not. It's a separate entity. And that's a lot of times what people don't understand is that when you're engaging in business, it's not you that is engaging in the business. It is your business. And if you think that I'm going to say that it was me, then what I'm doing is I am blurring the distinction between the business and myself, and that's going to give rise to a veil-piercing argument. So if your mind thinks that the entity is you and you are the entity, then you might want to avoid setting up an entity because it'll never protect you in a lawsuit if that is the way you view entities. All right, here's some quick questions that always come up about this. Will this create, or can I use a C Corp when I'm doing this? Yes, absolutely, you can use a C Corporation. It doesn't have to be an S Corp. It really depends on where you're at. When you're putting this deal together from a tax standpoint, if a C Corporation could be more beneficial to you. What about doing a JV with a realtor? I got this question not too long ago. They have the license. So that might work for you. It depends on the state and what disclosure requirements and what type of deals they can put together. Whether or not you should bring a realtor involved into your wholesaling business. Generally speaking, if somebody holds a license, I prefer to stay away from that when I'm conducting business because that imposes a greater duty on you as the individual who's putting the deal together. All right, what happens if I want to keep the property and I don't want to sell it because Maybe it doesn't sell, or I just realize, hey, there's an opportunity here to do a flip. Hey, that works as well. Then you just close on the property yourself. But here's the thing. If you close on it, you want to make sure, A, it was held in an LLC for sure, so it's not inside of your business. And then you should look at setting up a separate entity for your flipping activity. If it's sporadic, then just do it through your wholesaling entity. But if you're going to be doing more of those, you think that as they come up, then I would definitely look at creating a different flipping entity so we keep the two activities separate. With our very active clients who are involved in both wholesaling and flipping, that's generally how we structure their deals. All right, listen, hey, as I stated earlier, if you want to get a copy of the recent states that have imposed additional duties on wholesalers, there's a link below. You can download my Wholesale Without Worries checklist. And if you want to learn more about asset protection, be sure to subscribe to this channel. I also like to tell you this. Hey, if you're wondering about how to structure entities and get more familiar with LLCs and land trust and corporations as a real estate investor, we teach a weekly event. It's on Saturdays. It's called our Tax and Asset Protection Workshop. And at that workshop, you will learn about how to put a solid plan together that not only protects your real estate, but also ensures that you're minimizing your taxes on your deals. Listen, this is a one-day course. It's completely free for you to join this event, and you will get so much out of viewing that event. In fact, we have people that will come to it multiple times throughout the year just to soak up the information, because it's always changing. We're always adding new stuff in. And if you want to take advantage of that offer to be part of this event, I've got a link in the show notes below that you can click on where you can register. It's absolutely free. It'll be the best one day. I guarantee it's Saturday. You take out of your time to learn about this type of planning and what it can do for you. All the best with your investing.